I mean, look, the only market neutral funds that I see actually do a decent job of being beta neutral are the systematic types, beta neutral. And that, if you do it well, you are going to be very different, and as we've seen over the last 5 years for a lot of these guys. But the vast majority of kind of fundamental based market neutral managers, when I've measured their beta, they're always running hot, right? They're always running between 0.1 to 0.3 correlation to the S&P, or in Canada, the S&P TSX 60, which is problematic, right? Because, again, they're getting their fee. That's what they have to do in order to survive. Mm-hmm. And when you see something, for example, like AQR doing the correct implementation that they were paid for to be beta neutral and go through the drawdown that they've gone through, is that a failure, or is that a success from the perspective of proper execution of a market neutral strategy, right? They are not. They certainly are non-correlated.
Yeah. I mean, everyone likes to say non-correlated, and I want a negative correlation, but you need to go through some long periods of pain, right, for it to eventually pay off. And I mean, I think if folks stuck around with Cliff and AQR, they're very happy, this year. Mm-hmm. I think if folks have stuck with trend following and even kind of, beta one commodities or long ball in some sort of, fashion, they were very happy in 2020. This year they're fairly happy as well. Not so much in the long ball space this year, since the implied markets really haven't moved as much as you would think based on, where we are today in terms of the negative prints in the market. But however, you can't time this stuff, and that's why you need to set your strategic allocation across those three components: first responders, second responders, diversifiers, and just rebalance as those things pay off.
Just slap on a 200-day moving average on that pure alpha, man. Problem solved, right?
Not advice.
Well, you know what? The pushback on the long vol side is it's negative bleed, and it's like, well, yeah, if you hold it in perpetuity, it's a negative bleed. But once it pays off, if you rebalance to buy beta one, or if you rebalance, say, into trend following or diversifiers, then you're going to do pretty decent there, I think.
The beautiful rebalancing premium that nobody talks about, right? In isolation, it's a problem, but once you include it in a multi-strat, it adds tremendous value. So
our clients. Okay, go. You got it.
Just last question with regards, because I want to finish up on market neutral. The idea of hedge funds, alternatives, whatever you want to call them, has always been. There's another moniker here, which is the absolute return label, right? And so the belief here is that if you're an absolute return fund, you better be providing returns in every single year in good and bad markets. This is the Ed Thorpe. Was it Ed Thorpe that came up with the first hedge fund, and that was what he was trying to do? And I believe he accomplished that for most of his career. Now we're looking at market neutral funds like these, where we do not expect a positive return every single year. We expect it to meander and provide a positive expectancy over long periods of time, but no guarantee of positive returns any given year. Are there absolute return managers out there that can accomplish that? Or are we now in the realm of it's just another risk factor that we're allocating to with drawdowns and bull markets?
Yeah, I mean, it's strategy by strategy, and you're not going to invest in one quote unquote absolute return manager. And again, that's not even like a term that I would use to classify within like asset allocation. It's that. What is your correlation profile? And obviously that can be conditional, right, to what the market is doing. But I mean, absolute return standalone, it gets back to what I said before. If it doesn't keep up with beta one over a long time, bull market, and then when you do get those drawdowns, if it picks up that correlation, then people are just not happy there. They're not happy. And that's, if you want to be able to use the right types of hedge funds in your asset allocation, it's tough for them to stand alone. You need to package it up, I think, with some sort of beta, such as equities or rates, to use that as a complement to your traditional types of asset allocation buckets, such as global equities or U.S. equities or your Barclays Ag, or your investment grade credit book. Because again, otherwise, you go to the board every single quarter, and markets up. Oh, why is this thing only up 3% annualized over the past 5 years. Like, well, it has a beta 0. The correlation is really low. If we married it with some sort of equity futures or interest rate futures, then it would shoot the lights out relative to active long only equities or some sort of Barclays Ag or active long only fixed income. So I think if you really want to have a program that's going to withstand the test of time, that's really not the only way to do it, but the path that can keep you in the game.